Governments and large creditworthy firms can issue bonds to raise capital. Large creditworthy firms favor bonds over bank loans because typically they can obtain financing at a lower cost via issuing bonds than they could by getting a bank loan. Much of the terminology surrounding bonds comes from the old days when bonds were actually printed out on paper. For example, on the front of the bond, called the face of the bond, the dollar amount that the company promised to repay, and here we see is $1,000, would be called the face value or the par value of the bond. Almost all corporate bonds have face values of $1,000. So if we come across any problems where the face value, the par value of the bond is not explicitly stated, we can just assume it's $1,000. In the front of the bond, we also see all this fine print here. This is the bond's indenture or the bond's contract that spells out the obligations of the issuer of the bond, as well as some details about the particular repayment and maybe some features that are associated with the bond. You'll see here at the bottom a number of coupons. Well, in that bond indenture, it will spell out the interest rate associated with that bond. So if this bond had an interest rate of 5%, each coupon would be worth 5% of the face value, or 5% of the $1,000. So the interest rate is tied to the coupon rate. So when we say coupon rate, that is the same as saying the interest rate of the bond at issue. Now, because of this is contractually obligated, the interest payment, the coupon rate, does not change for the life of the loan, nor does the face value of the bond. Now, as interest rates change in the economy, the value of the bonds will go up or down depending on the movements of interest rates, but the coupon interest rate will not change. So if interest rates go up, and we know from our time value of money concept, when interest rates go up, the present value goes down, so the price of the bonds are going to go down as interest rates increase. And if you buy that bond at a low price, you may, and you hold it to maturity, your rate of return on your investment may not be the same as the coupon interest rate on the bond. Bonds can be unsecured. We refer to those as debentures, and only really creditworthy firms can issue these. Subordinated debentures are the same as a regular debenture, except they get paid after the debenture gets paid. So if the firm, for whatever reasons, runs into a cash flow problem, the debentures will be paid before the subordinated debentures will be paid. And some bonds, income bonds, they only pay interest when earnings are available. Secured bonds include mortgage bonds that are secured by real estate or buildings. We also have collateral trust bonds and equipment trust transfers, and I'll let you read about those in the textbook, as well as the characteristics of many types of bonds. I'm just going to touch on a couple of these in this slide. Again, all this is in the text, and you're just as well to read it as for me to read it to you. So, zero coupon bonds, these are bonds that do not make an interest payment, but instead are sold at a discount to par. And as a result, your rate of return will not include interest payments that a normal bond would. It would all be capital gains. We'll work through some examples of that as well. Floating rate bonds, those are bonds that the interest rate floats according to the overall level of interest rates into the economy. And we can also have puttable and callable bonds and some other issues, and some of these we'll touch on later on. But again, it's best just to read the text on this. Because bonds are debt instruments, credit ratings are important. Just as we have credit ratings as individuals, companies will have credit ratings associated with them and the bonds that they issue. The two largest credit rating agencies in the United States are Moody's and Standard & Poor's, and they both employ a combination of letters to signify the credit rating. So AAA is prime quality investment grade debt, where the likelihood of default, the borrower not repaying the loan, is very, very small. High grade is almost as good, but maybe a slight more likelihood of default. And we can go all the way down to BA, which is the lower medium grade or speculative. BAA, this is a medium grade, but still investment grade. So anything that's triple B under Standard & Poor's or BAA under Moody's, anything above that is considered investment grade. Anything below that is considered non-investment grade or speculative, and you'll also hear the term junk. That is important because investment grade debt, pension funds, which are by far the largest holder of corporate bonds, by law, they only are allowed to hold investment grade debt in their portfolios. So as a result, it's a huge increase, a very large increase in the cost of debt financing if firms cannot issue investment grade debt. So far, we've only considered risk-free Treasury securities, and we call Treasuries risk-free because they have very, very low levels of default risk. But for an individual company, a corporation issuing their bond, they're going to have some level of default risk. And as we expect, the riskier the company and the issue is, the higher the nominal interest rate the company will have to pay. Our required return, our expected return on a corporate bond is equal to the risk-free rate, which in turn is comprised of the real rate of return and the inflation premium. So we can think of the required rate of return on an individual bond as the rate of return on a Treasury bond plus a risk premium to compensate the investor for holding the risky debt of the firm. So the risk premium has several different components. There's the default risk component that the issuer of the debt will not repay the loan. There's also maturity risk. The longer the maturity, the more the value of a security will change in response to interest rates. We'll get to that a little bit later on. And there could also be provisions in the bond's indenture or the bond's contract that could affect the level of risk. For example, some of the contract features may reduce risk if it limits the amount of leverage that the firm can undertake. May also reduce risk if the bonds are convertible to common stock. Some characteristics will also increase risk. So we have the risk premium that's associated with the issuer, and then we have risk premium that's associated with this particular issue of debt. It's fairly easy to calculate the risk premium for an individual bond. So in 2013, U.S. Treasury bonds were yielding 3.18%. Now this is an average, so bonds you can have a 5-year bond, 10-year, 20, and 30-year Treasury bonds. Those were averaging about 3.18%. In May of 2013, the average of high-quality bonds yield was about 3.94%. The interest rate on medium quality were 4.76%, and the interest rate on the B to C speculative grade was about 5.46. If we want to calculate the risk premium, we simply take the difference between the return on the bond and the return on the U.S. Treasury to calculate that risk premium. As we can see here, the riskier the debt, the higher the risk premium. To get more recent data, I pulled from the Wall Street Journal Money and Credit page as of April the 21st of this year. Yields on U.S. Treasury. So the yield on 3-month Treasury bills was 52 basis points, 0.528%. The 1-year Treasury note, 0.81%. The 10-year note, 2.4%. And the 30-year bond, about 3%. Just to put that in perspective, I also pulled some consumer rates here. A 15-year mortgage at this point in time was 3.32%. 30-year mortgage was 4.14%, and a 5-year CD at your bank you could probably expect to get 1.24%. Then looking at corporate bonds, the Barclays Index of all investment grade non-speculative debt, the average of that was 3.34%. The average for AA corporate bonds was 2.7%, and the still investment grade BAA was yielding 3.66%, and the highly speculative CCC was yielding 9.87%. Wow. So to calculate the risk premiums, I calculated them over the 10-year bond, also referred to as the 10-year note. So the risk premium for the Barclays Index was 0.92%, and the for the AA, that was 0.28%. The still investment grade B AA, the risk premium was 1.24%, and a whopping 7% for the speculative CCC. Also for kicks, I pulled one of the Berkshire Hathaways bonds. Now, Berkshire Hathaway issues a lot of bonds, and I would have to do a weighted average. So I just picked out one bond that was maturing approximately 10 years from today. They had a bond that was maturing in year 2026. It's currently yielding 3.14%. So that risk premium over the 10-year note is 0.72%. And I got that information from Morningstar. Morningstar is a large provider of market data, including bond market data. So here we can see the page for Morningstar for Berkshire Hathaway. We can see Berkshire Hathaway here uses some leverage in their capital structure. They're about 72% equity, and they're about 27% financed by debt. They have a high credit rating. And we can look here, you can see they have several different bonds outstanding. For example, they have one that's maturing in, let's just look at this one right here. This one that's maturing in 2021. It has a 2.2% coupon. The amount outstanding, 1,000 million, so this is $1 billion bond issuance. And you'll see the price there is 99.7. That doesn't mean $99.7. That means that the bond is trading at 99.7% of face value. And recall that bonds have a face value of $1,000, so it's trading at 99.7% of $1,000, or $997. The coupon rate was 2.2%, and this bond, if we look all the way out here at the end, has a yield to maturity of 2.28%. So if you bought this bond for $997, you held it to maturity, your rate of return, your yield to maturity would be 2.28%. So to recap, corporate bonds have a risk premium above and beyond risk-free treasury bonds. And this risk premium increases as the riskiness of the bond increases. Default risk, as measured by credit ratings, we can clearly see that high-quality bonds have a smaller risk premium than lower quality, higher risk bonds. Because credit ratings are so important in assessing risk premiums, it's important that we ask, can we trust the bond rating companies? Historically, bonds that received higher ratings were almost always repaid, while bonds that were rated speculative or junk experienced much higher default rates. But during the 2008 credit crisis, the agencies attached ratings to complex securities that really didn't reflect the true risk of the underlying investments. Making matters a bit worse is that companies that issue bonds pay the rating agencies to rate their bonds.
For sitting down and doing this.
My pleasure.
The crisis of 2008, you've said that this was different than other economic crises that we've faced. Why?
It shouldn't have happened. Most of our financial crisis in the past is due to some macroeconomic event, an oil disruption, a war, a depression, and we can go into the causes of that. But this was caused by a few institutions, about 20, who, in my opinion, lost all credibility relative to managing their risk. They were very highly leveraged. They did not have a good liquidity program. And quite frankly, it even got into greed and I think malfeasance. And it then, because of what they did, and again, I have no sympathy for what they did. It was management incompetence, and it should never have happened. Unfortunately, our safety valves didn't work, and this thing blew up to a whole worldwide impact. And the sad thing is it should never have happened. The management.
The role that derivatives and financial innovation played in destabilizing the banking sector, or the financial sector, as you would put it. What were you seeing What were you, as this was going on, what were you thinking?
Well, there's nothing wrong with financial innovation and derivatives and so on if they are properly done, properly understood, and I guess most importantly, properly rated by outside parties who are supposedly objective and you can rely on them. One of the reasons that, and I think one of the most important reasons that this crisis got as big as it did, is that the exotic forms of these particular instruments incomprehensibly, some of which were rated AAA by the rating agencies. I cannot imagine how they could come up with subprime mortgages AAA rated. And therefore, particularly when it's AAA rated, people don't do due diligence. I mean, let's say that they're off by a little bit, so they're only a double A. They're still, they just bought this stuff. And I'll make this statement, that if the rating agencies had not rated so much of this, what I would call toxic subprime mortgages AAA, this crisis would have been small enough to be manageable and would never have got to the size it did. Just the rating agencies had done their job.
The rating agencies were paid by the banks, would have lost business had they not awarded those.
Not really, because there's only 3 of them. So they just the instruments either would have been issued of such a small volume it would never have made a difference, or now they made more revenue by rating these, okay, but they wouldn't have lost anything because there was nothing to lose.
But that's an incentive to rate them highly.
Well, supposedly not. They're supposed to be independent.
Supposed to be.
Yeah.
But they weren't.
That's correct. Now, again, I'm not trying to make excuses for the management who originated this stuff, but we have in this country checks and balances. And if people want to know why this crisis got as big as it did, one of the major culprits, and there's some more, were the rating agencies rating subprime mortgages AAA, which to me was totally incomprehensible. So what I was saying was bubbles occurring. In fact, we said it in our annual reports that the spreads on all risk classes were way too narrow, as if there was no risk in the system, and we saw risk all over the place. And there was hardly no distinction between what we would say were, high risk activities and low risk. They were all way overpriced. And in fact, we didn't even participate in the exotic subprime side of the mortgage because we knew that this was absolutely wrong for our customers if we would have done it, and it would have been wrong for us because we think this thing was going to blow up.
What did your fellow bankers say to you when you told them that you thought this stuff was toxic and you weren't going to bite?
Well, the ones that were in it said I was wrong, and everything's fine. We don't see any losses occurring in this. We think it's improving home ownership. It's good for low-income people who have not had a chance to buy a home. And my answer to that was the only reason you're not seeing losses because you're seeing massive delinquencies, 30 to 40% delinquencies. Sometimes in a significant amount of cases, people weren't even making their first payment. But what was hiding the losses was the fact that home prices between 2000 and 2006 rose by 120%.